you doing? My name's Nick. I'm here with Millennial Think Tank, and I just wanted to talk to you guys about what I did with my tax refund. Pretty much most people are getting a tax refund about this time, and I want to talk about what I did with mine, and so you can make your plans off of what I did. I'll tell everybody how it worked. We won't know probably if I did the right thing till next year, at least with some of this stuff. So I got about $3,500 in my tax refund, which is pretty cool. Cannot complain about that. That's pretty good. I know some people don't get one back, but I'll talk for the people who do. I looked up a lot of stuff that you could do with your tax refund money, trying to make the best decision. The first decision I made was to pay off the remaining balance I had on my credit card. On my credit card, I had about 800 and some change on there. Paid that off with that first little chunk of money to make sure everything was okay. Because with that, I get a guaranteed return on my investment because I'm no longer losing that 9%, almost 10% that I was paying on my credit card, which is crazy. I'm paying 9% to use their money, but I know it's better than a lot of other credit cards, but that's what I did first. And hopefully they can keep that balance at zero. That way I'm not bleeding money every month. And some of you guys are wondering, like, 9%, 9.24%, that's pretty low. How did you get that? How I got that was I went to my local credit union. For me, that's the State Employees Credit Union, CQ for short. And I just walked in there and said, could I get a line of credit for $20,000? You guys are like, $20,000? Yeah, they walked in there. That's just what I said. They said, how much do you want the line of credit for? And I sat down with the banker. I just signed in and said I wanted to get a line of credit. I signed in, and they said, how much did you want it to be for? And I said, and just like this, 20,000. And the lady was like, okay, just wrote it down. And she said, I'm gonna go run this information. I'll be back with you. I'm like, okay. Sitting down, twiddling my thumbs. And then she comes back and it's like, yeah, we got you. And here you go, $20,000. Here's a card. It's a temporary card. Your permanent card's gonna come in the mail. I'm like, that's great. Because of my little college credit card one and a department store card, both of those 20s, mid 20s, the low 30s almost, mid to high 20s, let's just say 25 to 29% between the both of them, and $500 credit limits. Like, what is that? If you use $100, you're at 20%. They want you to stay under the 20%. So if something comes up, you have to use $300. Your credit usage is at 60%, and that kind of affects your credit score a lot. Your credit usage. So you want to keep that low, and this helps a ton with that because now I have a $20,000 limit. So basically, my credit usage just went up $20,000. So $20,000 more to play with. But at $300, instead of it being 15%, it is now a percent. Probably like 1%, something like that. Is it 1%? A little over 1%. So that's cool. It makes it a lot easier and it keeps your credit in check. Because it also helps because $100 to $300, like, to me, that's not like too big of a thing, honestly. But it can. That's what it looks like. They look at credit usage, so age of your credit, lines of credit, so that helps, and that might help people. You can go there. Maybe you can go to CQ if you're in Maryland, and try and do the same thing I did. It might not be 20,000, they might approve you for 10, or they might approve you for 30. You never know. I didn't know. I went in and asked, and then you can use that 9%. You could basically put the money on there, like off your old credit card. Put the money on that one, and then you're paying that third less interest. That's something to think about. I mean, everyone's personal financial situation is different. That's something to think about. So after I did that, I had over $2,500 just lying around. So I just said, what would be the best thing to do with this? First thing came to my mind was stocks. But I'm still a speculator. I'm not an investor when it comes to stocks. Like, I wanted to buy Chipotle when the scare happened with the, was it E. coli or something you didn't want in your body was on their food and their stock dropped. I wanted to buy it then because I thought it was a good company. But I held off because I'm like, I don't know why it's a good company. Like, I don't know why. I just like to eat there. I don't know, like, what their market share is or anything. So I said, let me hold off and really try and learn this stock thing, instead of just going on Google. Because some of the stocks I have, I just went on Google and just looked at the Morningstar rating or whatever it's called and just picked it. I don't know why. Like with the Chipotle thing, I didn't know why. And I said I'm not going to invest in stocks, so I really know why. I picked up a book called The Intelligent Investor by Benjamin Graham. And that's been helping me learn. But until I actually can look at a company and tell you why it's a good investment, I won't buy any more stocks because I want to be an investor, never a speculator. So then the next thing on my mind was something it's probably in like every municipality, but Baltimore we have something called tax liens. And basically, if you don't pay your property taxes, they put a lien on your property for the taxes. So if you owed $1,000 in property taxes for the year, basically the government spends that money in advance, pretty much. So they want to have that revenue on their books. So they'll sell your auction to an investor. Like in this situation, you would have sold it to me. Or let's say didn't pay my property taxes for $1,000. Someone could come along and pay that $1,000 to Baltimore City, because that's where I wanted to get the tax liens at. Could pay that $1,000 to Baltimore City, and then I would owe that person $180 extra, 18% interest in Maryland. So I would owe them $1,180, and I had to pay that to them, or they could foreclose on my property. And that's kind of like the advantage of the tax lien. Interest rate is pretty high, and most people, they're going to pay that money. Like if they have the ability to pay $1,180, they would rather pay that than having to go find a new place to live. Sometimes the situation doesn't work out like that, but basically, like, it kind of has like a little bit of security, because most people aren't going to let their property go into foreclosure for something like that if they can help it. But if it does, you just picked up a property for pennies on the dollar. Sometimes the owner of the property isn't around anymore, or the kids got it, nobody wants to deal with it, so, and they just, no one cares about the property, and the property might be open. You can foreclose on that property in Maryland in 6 months. 6 months in a day, you can get a lawyer to start the foreclosure process. That's another process. It's going to take some time too. But if you can prove it's vacant, you can get it in 6 months. So basically, if you want to do a fix and flip, or you want to do a rental, you just picked up a property for pennies on the dollar. That property that's $1,000 tax lien, it might not be the best property, but you just picked up an entire property for $1,000. You could wholesale the property to somebody probably, if worse comes to worse. And if you do a fix and flip, you get in a property on pennies on the dollar. But like I said, I wanted to do a fix and flip this year. I'm going to do a fix and flip this year. So I didn't want to tie my money up for at least 6 months. They're going to pay me back sooner, but I want to go at least 6 months. My money's tied up. 6 months plus. I didn't know if I would need that money anytime, so I didn't want to tie it up. So then I started looking, maybe I can move my money to a different bank account. Because right now I'm getting 0.75% with Capital One 360 account, 0.2% in my check-ins, and then 0.1% of my savings at CQ. That's nothing really. Inflation is 3% on its own, so I'm losing money basically. So I just wanted to look in. It's like the best place I could put my money, in a cash equivalent, like a bank account. And I couldn't really find anything more than 1%. If you guys can, comment it down below. But I saw like the best one I found was like Barclays, and it was like 1.019, which is pretty good for a bank account, honestly, nowadays. But I wanted to do something a little better. I got more into it, and I found something called a tax-free municipal bond fund. Basically, it's a bond fund. The price you buy it in, like individual, like stocks, almost like stocks of the bond fund. But you have to have at least $2,500 to invest if you're going to do like a personal account. $1,000 for this individual account at T. Rowe Price. If that's good, $1,000 for the IRA for this individual account at T. Rowe Price, which is pretty cool. That's right up my alley. And with this particular account, it has a particular fund, and there's a 0% redemption fee and 0.46% expense ratio. But most importantly, it has a 0% redemption fee, because that allows me to use this account as a cash equivalent. Basically, because the redemption fee, if it was like 1%, they would take like 1% of the money every time I took money out. Since it's 0%, I could take money out whenever I want, So basically that money's sitting in there, and past performance isn't the same thing as future performance, but The last couple of years, I got 3%, 4%, 3%, 5%. I think I lost money the year before that, if I'm not mistaken. So it is like a stock, like the individual shares of the bond fund can go up and down, but in like investment grade municipal bonds, like the failure rate is like less than 1%. So basically, this information I found, the failure rate is less than 1%. So basically, the ability for the municipality that you're loaning money to default on your bonds is like less than 1%, which kind of makes sense if you think about it. What are the chances of like most cities going bankrupt? I mean, you have to do your homework because I mean it does happen. It's not 0%, but your principal is safe from like totally getting wiped out. But it can go up and down. Like the $2,500 can go up or down, but over time it's tended to go up. Like with most things, over time it's tended to go up. So that's pretty cool. And you also get dividends. Dividends are going to be paid quarterly, so once every 3 months I'm going to get a little dividend on my money, which is pretty cool. Like I can't complain about that because the dividend is exempt from federal taxes, and because I'm a Maryland state resident, is exempt from state taxes. So basically, my money gets to grow tax free, which is actually kind of better than a bank account. You know, like it's a little bit better than a bank account because technically you're supposed to pay taxes on the interest you get in the bank account. So I'm getting higher interest and it's tax free. I get to keep all of it. So it's pretty great, honestly. I'm pretty excited about it, you know, because I'm not paying any money and my money's growing and it's over 3%. Remember that 3% I said a little while ago? So basically, I'm not losing any purchasing power. I'm not really making any money with this, but I'm not losing any money because every year your money sits in a bank account and it's lower than the inflation rate. You're losing money because like your purchasing power goes down. Same way when we were little kids, us millennials, like bag of chips was like 50 cents, now it's like $1. Like over time, you lose that purchasing power. So that's why you want to have your money in vehicles that you know at least you want to have cash on hand. But like once you get a good amount of cash on hand, you want to start putting your money in vehicles that at least meet and exceed inflation just to keep your purchasing power. Because inflation is eroding that dollar as we speak, you know. So I'm pretty jacked up about that, and I got that through T. Rowe Price. Actually, I'm able to answer all these questions, not answer all these questions, give you all this information because I just called T. Rowe Price. This is actually pretty cool. Every time I do something, I recommend calling these companies, you know, using the phone. I know you can do everything online, but if you're new to it like me, you can call and double check. You can write down the people's names, you know, because this is new information. Like, you don't really learn about municipal bond funding in school, unfortunately. But you're able to write down the names, write down all the questions. You can talk with an experienced investment advisor or people who have experience with this, and they can answer all your questions. He was able to answer my question about the redemption fee, and I just called T. Rowe Price and set it up over the phone. It probably took me like an extra 5 minutes, but the extra 5 minutes for the knowledge that I gained is it really, and to feel comfortable. Because yeah, it says it, but is it actually true? You know, like yeah, it says this thing, but like, can you really explain to me these fees that are going to come? And he explained to me that it was going to be like $20 management fee if I didn't do like the online everything, like the online statements, online updates, online everything. But since I did that, which is no management fee on my account. So basically, I just had the expense ratio for them managing my money inside of the bond fund, which is pretty cool. 0.46%. That's not bad at all. So that's pretty cool. That's all I got to say, pretty much. So just follow me below, and if you have any questions, just I guess message me or leave a comment below. Is Nick signing out, Millennial Think Tank? Thank you.